for joining today's webinar, Equity Management Through Every Stage. My name is Sartaj and I'll be your moderator this morning. You will see a webinar pane in front of you. Please note that the orange arrow will allow you to minimize or maximize the pane. If it is minimized, simply click on the orange arrow to bring it back. Feel free to submit any questions that you have for our presenters throughout the duration of the webinar. Our presenters will handle the questions at the end as time permits. If you're using your telephone to listen in on our webinar, please make sure you select Use Telephone. If you are listening in through your computer speakers, please select Use Mic and Speakers. If you have the incorrect setting selected, it will produce an echo sound. To qualify for California CE, you must use a personal computer and log in with your own information and unique URL. Be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of the webinar. Actively respond to at least 75% of the polling questions, and complete the evaluation survey at the end of the webinar. With that, I'd like to introduce our presenters this morning. First, we have Scott Shorts. Scott leads the Equity Management Solution practice at Armanino and has worked with the legal and financial industries, providing financial and consulting services to public and private organizations. Scott also has extensive experience in equity compensation and evaluations. Scott works with finance executives on their stock-based compensation and other equity transactions. Next, we have John Duffy. John is also part of the equity consulting practice at Armanino and has more than 6 years of experience as an audit manager, in addition to senior accounting analyst. John also has extensive knowledge in stock option administration and equity management. Lastly, we have Tom Bondi. Tom is a tax partner with Armanino and serves startup and early-stage technology organizations. He specializes in ownership transitions for funding of companies and stock options for the firm. With that, let's cover today's learning objectives. First, we'll discover challenges and pitfalls organizations face in the various stages of growth when it comes to managing equity. We will review how some of our peers navigate these challenges to ensure equity was managed properly. And lastly, we'll uncover ways to stay compliant with tools and services. In terms of the presentation overview, we will define typical stages of a company's development. We will highlight key issues with each stage, present real and hypothetical common equity issues through a framework of actual client case studies, and lastly, we'll discuss company case studies and solutions. With that, I would like to turn it over to Scott Shorts.
Thanks, Sartaj. Very efficient, right to the point. Let's get into it. Thanks for joining us. This slide is just outlaying some of the investment items that have happened in Q1. So really not going to get into too much detail, but the trend actually has been surprising. The change or shift from early stage investments in Q1 to some later stage investments. So you can see over a 30% drop in startup or rapid growth companies and a 50% increase in later stage companies. So this may be investors looking at diversifying risk or trying to shorten their holding period by investing in later stage companies. It'll be interesting to see if Q2 we have some of the same trends or if the early stage investments kind of pick up again.
All right. What stage is your company in? As we look at equity through every stage, we've established general stages of a company's growth, and we put it on a roadmap. The first stage we have being the startup or the fledgling stage, followed by rapid growth, established, expansion, and finally exit or the liquidity stage. We aren't going to talk about the exit stage as that's really a different ballgame. Also, I want to note that the stages of a company's growth don't really fit a model as we have it laid out for you here today. You know, a company can jump from startup to exit. They could mix and match or put it in any order.
And with that, why don't we start with our first polling question today. The question is, what stage of development is your company in? Is it A, startup, B, rapid growth, C, established, D, expansion, or E, not sure? We'll give you a few moments to make your selections. And with that, we'll go ahead and close.
All right, it looks like most people are in the rapid growth stage. So the success stage. We got some people in established and kind of all over across the board. 5% aren't sure.
It's exciting. A lot of rapidly growing companies we have with us today. Very exciting.
All right, the startup stage, the first stage on our journey, generally characterized by smaller companies, private companies, newly funded VCs, angel funding, or they're bootstrapping it. In this stage, companies are concerned with obtaining customers and delivering their product or service to the market. Cash is managed tightly at this stage as companies are trying to meet the demands of their startup. It's usually the main concern.
Yeah, and some of the top issues, just to dive a little deeper, and we're going to be covering these in even more detail in the next slides, but is managing founder stock. Who do you grant? How do you grant? How do you keep it? How do you not dilute it? Same thing with funding, finding it, figuring it out, setting up an equity plan. So a lot of what we're going to discuss today is around equity management and equity to your employees, how to set that up, and some of the solutions and pitfalls there. And then equity tax issues. You may not think about it, but early stage companies need to be thinking about, especially founders need to be thinking about potential tax issues right from the onset.
The next slide we're talking about is what are some of the challenges that the founders have in the early stage and as you start to look out for investors. And so one of the early things you have to look at is, do the founders have vesting schedules for themselves? And I think one of the things you have to look at there is how long have the founders worked together. If they work together for a long time, they might be a lot more trusting and not necessarily have a lot of vesting for themselves. On the other hand, if they've only known each other for maybe 3 to 5 years or less, then certainly the founders should have a vesting schedule to help protect the company. And so those vesting schedules are typically going to be 3 to 4 years, depending on the comfort level of each of the founders. And so when you look beyond, when you're forming the company, you'll have to look at what are the number of authorized shares you're going to do? How are the founders receiving their shares? That's an issue you want to know, whether you should book it, whether there's some tax issues that occur at the founding stage. But also, if you're going to be going out looking for funding, you want to know what that path is going to look like. And the moment you start taking money, you're down a path that you need to know how you're going to give up how the founders are going to be diluted. So the dilution process is a very challenging one that most companies have throughout the life of their company. And sometimes you get down the path, it's too late, a point of no return. So you're going to look at the stratification in your hiring plan over the next 2 to 3 years, and that stratification is going to help you understand which size of your option pool you should have, so that you know that when you're going to be granting shares to people, what is that going to do to your dilution? That stratification will also help you later. We'll talk about the option plan later in the program, and so we'll come back to that issue. But you want to plan ahead for the first round. You want to plan ahead for the founders maintaining control for as long as you desire to have control, and the types of options that you'll be needing to look at. The next slide here is what kind of challenges you're going to have to attract investors if you don't have an organized cap table and you haven't given it thought. You certainly don't want the investors, whether they're convertible debt holders or whether they're initial seed investors, you don't want them to be dictating your company early on. So you want to know what that dilution process, again, is going to look like, and how you're going to hand out equity. Sometimes in early stages, companies will give out equity too fast to contractors without giving the thought to whether that's the right decision, and maybe they should just be promising money instead. You want to avoid the loss of the control at the early stage, and that loss of control could be over 2, 3, 4 years, and it happens rather quickly as you start to get into funding rounds. So best is to pull your advisors together and plan through that that dilution phase. We got 409A up here, and 409A is a section in the Internal Revenue Code that demands that the value of the options that are granted or RSUs that are granted to the participants are at fair market value. So you don't have to become an expert on 409A, but you do want to talk with your advisors about the implications of that, and it will have an effect on the types of options. The challenge here is that a lot of times in early stage, founders try to give their early employees as low a value as possible, but you do need to have some extensive discussion at your board meetings on this area.
Have some basis, right, for that. Right. And that really plays into the equity plan, as Tom alluded to, and that's where vesting comes in. The other thing to note is that your investors, while maybe when you start as founders, you may or may not have vesting conditions to your founder stock, your restricted stock awards, but investors may come in and that may be a requirement and to have some sort of vesting or subject to forfeiture in your award. So just be aware of that. But the challenges of an equity plan is that it's really one of the most diverse processes within an organization. And when you're looking to establish a plan, you have to bring a lot of parties to the table, a lot of stakeholders, legal, finance, tax, HR, your participants, definitely want to get them involved. And, the questions of whether you're going to have a broad-based equity plan versus executive or VP level and above is something to consider. Tom mentioned about the 409A, so that's important. And then accounting becomes an issue. So stock-based compensation, while maybe you're not going to be audited right away after you roll out your equity plan, that's just something to consider down the road. And if you can start doing your stock-based comp early on, the better. Administration can be costly. So as we sort of have here in the solutions and tips, make sure you bring a number of stakeholders to the table, hire a good valuation firm. They can be part of the beginning process. Hey, we're rolling out an equity plan and we'd like to see what the value of our stock is before we grant our initial awards to employees. And then we'll be hitting on this note a lot, but documenting your policies and procedures. So what is your standard grant agreement? What's the process of a new employee? What goes in their offer letter, from their offer letter to the board minutes to the actual grant agreement? What does that process look like? Who owns that process internally? That's all going to be part of when you're first rolling out your equity plan, really establishing those rules and boundaries and making sure everybody across your organization is on the same page.
I want to comment on that, Scott, just on when Scott mentioned about the offer letters. It's really important for companies that when you're considering ISOs, and we'll talk about that in a little bit, when you're considering ISOs, make certain the board does not approve any option grants for soon-to-be employees until sometime after they have started working for the company. Otherwise, they're technically not considered ISOs. So we'll talk more about that.
Yeah, and actually that reminds me as well. If you're it's not recommended to put the value or the exercise price in an offer letter, only because the exercise price is going to be determined by the board, maybe after the fact, after they've gotten that offer letter. So that's a gotcha that we've seen where you've set a price and then, maybe 3 months later the board meets and grants awards, and there can be a challenge with that.
Scott, one other thing that comes to mind is on the vendor contracts. Since you brought up vendor contracts, one of the areas that we see a lot of mistakes on is, let's say that I'm going to hire you as an outside contractor to do some work. Mistakes can be made where the contract will say, I'm going to pay you half in cash and half in stock. That's a danger for the companies because it can have an effect of setting the option price. So It's really more important to have the contract say a specific dollar amount and a specific option grant of shares.
Yep. And again, make sure you have good legal counsel helping you, whether internal or external, in that process. So jumping to some of the tax-related items. So a Section 83B basically allows somebody to early recognize income, if there is, and it starts the clock on capital gains. So it's most commonly used when we're talking about equity with restricted stock awards. So restricted stock award is something where a person actually owns the stock. It's going to be outstanding on your capitalization table, but it may still be subject to future vesting. So, and the same is true for an early exercise non-qualified option. If you allow early exercise, and somebody may be able to do an 83B, in both cases, they're electing to recognize income, if there is any, immediately, and thereby, in the case of restricted stock award, at each vest, there's not a taxable event. So just remember, if your employees are electing or doing the 83B, it's within 30 days from the transfer of ownership. So that would be the restricted stock award grant date or a non-qualified exercise date. And really, the onus is on the employee themselves. But as a company, you may want to help them through that process. Again, we don't recommend giving tax advice, but just in making sure the documentation gets completed. And you would want to retain a copy for yourself as well to make sure all of your tax items and reporting are in line. The other thing to be considerate of is IRC 422D, which is the $100,000 rule. So incentive stock options are tax advantageous stock options, right? Meaning that the employee is not taxed upon the exercise, which a non-qual is, but instead they're taxed upon the sale of the stock, post-exercise down the road. But the rule states that you can only have $100,000 worth of incentive stock options vest in any given year. If you go above that, then it automatically becomes a non-qual. So you want to be aware of that, especially the biggest gotcha we find is when you do have early exercise provisions in your awards. If you have an early exercise provision, that entire award, the value of that award gets triggered immediately upon grant because it's 100% exercisable because it's early exercisable.
I'm going to add some on there, Scott. 83B, just so for your reference, the spread between, there's a section 83A that basically says that the recipient does not have to recognize any of the income attributes upon the exercise if there's some restrictions in place, such as a vesting schedule. 83B is an election that the participant can file within 30 days. It basically elects to say whatever attributes, if any, there are, I elect to pick up immediately, which could be zero if the option price and the fair market value at the time of exercise is the same. Along the lines of what Scott was talking about with ISOs, the spread that we're talking about, the fair market value and exercise versus the option price, is an AMT preference item. So it's picked up for AMT purposes, but not for regular tax. And there's a clarification that came out a long time ago, some 11 years ago, by the IRS that clarified one of their positions, which is an A3B election will not apply at all for regular tax purposes on an ISO exercise. So the point there is that if you have key individuals that you're planning on giving an option grant to where you know they wish to exercise early, then for those grants and for those key people, I would do a check the box non-qual so that it does, so that 83B does apply for regular and AMT purposes. Otherwise, enforce your vesting schedule and do not allow early exercise on any ISO grants.
Yeah. And generally, I think the last point on here, generally just they're consider the tax burden potentially on employees. So restricted stock having a taxable event upon vest, basically an employee doesn't necessarily control that vesting. So just some items you want to consider. A couple questions we'll just answer really quickly. So the ISO limit is neither upon vesting nor grant. It's upon when it becomes exercisable. Typically, right, that is upon vesting if you don't have an early exercise provision, but it's a minor differentiation. So if you don't have early exercise, then yes, it's going to be when the grant is going to vest. But that calculation is actually done upon grant.
And it's based on the option price, not on the fair market value as the vesting occurs. So that $100,000 limit per year, per calendar year, is based on the number of shares to vest each year at the option price.
Right, it's not changing every year. So and it's based on all of your ISOs you have outstanding. So it's a first in kind of approach. So the most recent ISO would be the one that might be triggered over the limit, as opposed to maybe the earliest ISO. And you don't get to choose that. You can't choose the lowest exercise price or the highest exercise price. It's based on the time and the pattern of when they're granted.
All right, so we got our first client spotlight up. Symphonia Healthcare Corp is a client of ours here at Armanino. Symphonia is the Italian word for symphony, and they look to harmonize the healthcare industry in the same manner that a symphony harmonizes sound by providing top-notch hospice and home care. They initially rolled out their plan, a stock option plan in Excel, but soon understood that the complexities of their equity structure was too much. They wanted to focus on what they were good at, which is providing top quality healthcare. They partnered with Armanino, and we helped them implement a cloud-based software early. And rather than having an unskilled accountant or an overpaid top-level employee implement the software, we performed the implementation to ensure that it was done properly. And they continue to utilize us as we assist them with managing their equity plan and their activity and preparing their audit and audit footnotes. And the end result is that they have greater assurance that they can provide to their investors and their board members, which allows them the space to make the right decisions for the company.
Great, thanks, John. So with that, let's jump into polling question number 2. The polling question is, what is an 83B election? Is it A, year-end tax reporting form for option exercises, B, tax penalty form for not filling returns timely in a timely manner, C, optional form filled upon the transfer of ownership, or D, A, vote for simpler tax forms, or E, I guess, not sure. We'll give you guys a few moments to make your selections.
Oh, it's changing.
Yeah, it's a tough one.
Great, please take these last few seconds to make your selection, and then we'll go ahead and close the poll.
All right, so we have a lot of you answered A, which is incorrect. The 83B is an optional form filed upon the transfer of ownership, and it's a way to accelerate income recognition to the date of an early exercise option or a restricted stock award. So
Yes.
For those of you that pick C, you are correct.
Yeah, about 37%. So definitely an area I think Tom would agree that we've seen some confusion on. But ultimately, as John said, it's an election at the time of grant or transfer of ownership. It's not a year-end reporting requirement. So we're going to dive right into the rapid growth stage, which many of you are in. This is really when maybe we're going from beta to launch. Potentially seeing some revenues, starting to establish a larger workforce, and really growing the company. So some of the key issues, the equity issues, become equity accounting. We touched on that, but usually companies in this rapid growth stage are starting to have audits or debt covenants or something that required an audit. Cap table management, you might have more rounds of funding, more shareholders, all of those items. And then really, again, plan administration and reporting become bigger and bigger issues because you just have more stakeholders, more employees, and more activity. On the equity accounting side, again, we're talking about the accounting that's going to impact potentially your financial statements. Like I said, for your investors, you might need an audit or reviewed or compiled statements. Or for a debt covenant for a bank of some kind. So you want to be careful to get these right. Your auditors are going to spend a lot of time on it, and hopefully internally you can have it streamlined. But be aware, Tom mentioned it, if you're granting options before somebody's actually been hired, they're most likely going to be considered a consultant at that point, and there's different accounting. So consultants get marked to market at every reporting period, whereas an employee has grant date fair value. So you want to remember to handle that properly. And when we're talking about stock-based compensation expense, just so everyone's on the same page, we're talking about a charge for the compensation that you're granting to employees. So similarly, that if you give somebody a $100,000 salary, you're going to be charged that expense on your income statement. In the same way, if you grant somebody $100,000 worth of options, it's going to be amortized or expensed over the vesting schedule of those options. Forfeiture rate, that's an item where you're allowed to take a haircut off of your expense, right? Because your option expense, your stock-based comp is an estimate, because if somebody doesn't vest, meaning they terminate before their option vests, then you actually get to reverse that expense. And so we've seen some issues or companies struggle with sort of the concept of vesting and reversal and forfeiture rate. So one thing to be aware of is that your forfeiture rate should be based on only on unvested cancellations, right? So if somebody vests 50% of their award and forfeits 50% of their award, that forfeiture calculation in that case would be, well, I used a bad example. Let's say they vest in 40% of their award and they forfeit 60% of their award. That the forfeiture rate, quote unquote, for that award is 60%. Another thing to consider is reversing the expense. You only reverse expense for unvested shares that you've previously expensed. We've seen it time and time again where companies reverse all of the expense associated with an option because the employee doesn't exercise and they leave the company. The guidance does not allow that. Once an option vests, that expense stays on the books regardless. It sort of disappears in la land, but that expense stays on the books. Modifications are a big one. A modification is any change in the terms and conditions of an award. Most common kind of small, small modifications are changing somebody's vesting, right? Accelerating their vesting or giving them more time to exercise post-termination. Those are some common ones. Don't have your CEO doing that on the back of a napkin. Have that go through a proper comp committee or board and have it documented and then account for it properly. Again, a software system can help you just completely streamline this process, calculating Black-Scholes, calculating assumptions for you, Black-Scholes assumptions, and then ultimately amortizing the grant for you. So when you get to this point of needing stock-based compensation expense, definitely recommend looking at software systems to make that process a whole lot easier.
I just want to comment on Scott on that. For the listeners, most of the information we're talking about here, we're talking about accounting treatment issues, not tax treatment issues. So be sure to work with your advisors on the impact it has to your financial statements.
And we're talking about ASC 718 on that. So going more to an administrative component, and John is going to touch on even deeper, but your cap table, as it grows with new rounds of funding and new investors, you have to be able to present that well to your board, to your investors. One of the traps is to try and provide each investor the way they want to see the cap table. Sometimes you can't get around that, but ideally you can determine the best and most efficient way across the board to present it to your board and present it to your investors. Otherwise, you have to do a lot of work to customize it for each investor, each stakeholder. Another item that your investors may want, or even internally the organization may want, is looking at scenario analysis or waterfall analysis. And that can help you anticipate future dilution. It can determine who's in the money if you were to liquidate at a certain amount, or alternatively, if you had a new round coming in, you could calculate different term sheets and what the impact of that might be to your company. Waterfall analysis is a similar exercise, but it actually looks on class by class, tranche by tranche of your securities and who is going to get what in a potential liquidation based on a certain value of liquidation. I think it's funny, but it's very simple, and we touched on it. We'll probably touch on it a number of times, but getting out of Excel into a cloud-based system can just make this process much smoother for you. Reporting to boards, doing the scenario analysis can all be done. There's a number of systems out there that can make your lives a lot easier.
Plan administration. And when talking about common problems with plan administration, we're talking about the little things that are commonly overlooked. This slide has a few common errors listed. Grant terms and board minutes don't match the grant letter. Number of shares granted is unknown. Stock is granted without approval. And they usually stem from a lack of care to ensure that the information is being communicated, or that the information is being communicated to the right people. The solution being, give your stock option plan the attention needed to ensure that it is being properly administered. Make sure that when you're writing policies for how to document and communicate information, take the steps to ensure that those policies are being implemented properly. Finally, process information timely. So 6 months, 1, 2, 3 years down the road, you're not trying to figure out what happened back when.
Yeah, and I think that last point is huge. We're all busy. Typically, we find there may be multiple hats that people are wearing at that point in the organization. Whoever is administering the plan, you probably don't have a dedicated stock plan administrator, but figure out how to build it into your process, build it in, and do it as timely and in the moment as possible. Additionally, leverage help either individual consultants or outsourcing the process to help you through that.
On to reporting, we have listed on our common problems a list of reporting requirements that you might be facing, and they all can be riddled with problems. Starting off with board reporting, make sure that you're aware of what your board wants to see and that you're tailoring your information to be meeting their needs. We have a calculation on the right of shares authorized, or the shares reserve, which is your option pool, your options available to grant. And it's a formula that's commonly misapplied, although it's pretty simple. It's shares authorized less shares granted plus shares canceled. And be aware that when you're applying this formula, that canceled shares can be from different plans. So you aren't mixing the canceled shares between plans or trying to bring shares back from a plan that had previously been retired. And then we have for the audit. I think we could go on for days about how to prep for the audit. Could probably have a whole nother webinar. I think in our archive we do have a webinar on preparing your stock comp plan for the audit. But here we have a checklist. It's one of, I think we have a snapshot of the first page of a 3-page checklist that we have here at Armanino. It's a pretty good checklist. And if you guys would like a copy, you can email us, and we'll be sure to get back to you with our audit checklist.
Yeah, another case study here, and this is company Adroll, very exciting company, fast-growing company. They're in the SaaS space for marketing. They have a marketing platform that helps companies really manage, personalize, and exploit their campaigns. They have a great retention rate. I know the people there are very happy to work there, and they have a lot of happy clients. Adroll has a broad-based equity plan, multinational, and they really use equity as a form of retention. And ultimately, that they track an extensive amount of data for their equity plan because it is broad-based, and that can be challenging. And before they changed, they were managing this externally through a third-party provider. It was very expensive. They didn't have a lot of insight or direct control over the data, having to call somebody when they needed something. So ultimately, Adroll saw that they recognized the need to bring it in-house and manage it internally, and they had the internal resources to do so. They went through an extensive review process with vendors. We were fortunate enough to be selected along with the software certain to get their equity plan set up right on the system and be able to provide them support, advice, be an advisor to them as they needed, as they grow. And they didn't just stop there. They actually took the system and they built processes within their organization around it. Our contact there spent an extensive amount of time educating others across the finance organization what the functionality of the system was and being able to leverage it to mitigate some of the risks of equity plan management. The last thing, which we're going to talk about more even in the next few sections, is they rolled out the participant portal. So gave employees a place to view and see their equity and really make equity a big deal at the company, similar to somebody being able to log in and see their bank statements.
Great, thanks, Scott. So let's do polling question number 3 now. The question is, how often would you use scenario analysis for your cap table if you had it? Is it A, never, B, every day, C, once a month, D, once a quarter, or E, only prior to funding? And just as a reminder, we will have a recording of this presentation and a copy of the slide deck within 3 business days. You can email that out to all participants. Also, we'll just give you a few more moments to make your selection. Great, and with that, we'll go ahead and close the poll.
So it looks like about once a quarter is the common answer, and that's good to see, actually. That means that companies and boards are interested in what's happening next and what might be to come. So sounds like only prior to funding. That's definitely a common response. Once a month, yeah, I'm excited to hear that people are really interested in playing with a tool like that. It would be great to have another question that asked how many people have the ability to do scenario analysis today. But
the only comment I want to make on that is that if you are infrequent in terms of looking at your cap table and the analysis for that, you may lose track as the founders of the company in terms of your entire dilution process. And so you always want, if the more employees you have, the more options you grant out there, it's easy to lose track of where you are in the dilution process, and the board kind of demands that as the leader of the company, you know what your split on shares throughout the company is as you go along.
So diving into the expansion stage, and this is really, again, a company is growing. You can see we've kind of rearranged established versus expansion. It's not any particular order, but we're looking now at companies that are scaling up, maybe new partnerships, new talent. They might be expanding geographically, looking at acquisitions or M&A activity, getting ready for a potential liquidity event and an IPO. Those are all issues that companies in this stage have to deal with. And then employee education, Tom's going to cover some about that. That becomes very important throughout the stages, but definitely in this stage. Looking at geographic expansion, recognize that you may need to deal with different award types in different countries. There's different tax consequences. You may have to file certain security forms and statements. So that can be a challenge. So before you just take your US plan and apply it overseas, we recommend working with legal global equity advisors, right? There are firms out there that specialize in equity, international equity, and they know their stuff. They're going to be able to look out for any of the pitfalls and challenges. So do your research. The other thing is to consider that you may need different plan documents. So your US plan may not apply, for example, Privacy laws in the EU are different, so you may need to have some clauses in there different from the US. And a huge call out, which again, it gets back to education, which we're going to touch on a little bit, but is your international employees may not understand equity as well as your, if you're here in the Silicon Valley, but as well as your US employees, it may be very different for them. And especially when it comes to tax consequences, not all awards are created equal. Some awards here in the US that are not taxed until exercise or vest may be taxed upon grant, and that can be very scary for employees. Getting into M&A, there's one of the biggest questions is, what do you do with an option plan if you are acquiring an option plan? Do you assume it? Do you pay it out? Do you cancel it and just simply grant new equity under your plan? So there's accounting considerations as well as operational considerations. From an accounting consideration, if you're not obligated in your purchase agreement to replace the plan or replace the awards, and you do so anyways, then it's just post-combination expense, just regular stock-based comp. If you are obligated, then there's some very complex accounting. You have to do a before and after calculation. A portion is going to go to the purchase consideration, and then the other portion of the grants are going to go to post-combination expense. So it can be challenging, something you want to prepare for ahead of time, definitely. And then change of control provisions, you want to watch out for those as well, because there's some impact on accounting, whether they're in there or not, depends on where it goes on whose books.
I think one of the things to point out there is your board should have extensive conversation when you're in the M&A process as it relates to should we accelerate or not accelerate. And typically the reason you do that when you look at your cap table for acceleration on the transaction is to determine who's going to be rewarded during the transaction. So oftentimes you want to take care of the key people that have helped bring it. So be sure you have a lot of attention on that when you're going through a transaction.
We're talking about IPO readiness. So obviously the SEC and the auditors, they're going to scrutinize equity. It's one of the most highly scrutinized areas. So start early, and as I said, focus on equity. Cheap stock is one of those. It's a very scary word, but from an accounting perspective, it may just mean that you need to take more charge. You may need to recognize expense for awards that have a lower exercise price than the fair market value for accounting purposes. Earnings per share, that's probably something that you're not previously calculating, but your equity impacts that, basic and diluted, depending on if you're profitable. If you're not profitable, some people don't know this, you don't have to report diluted EPS because it's anti-dilutive inherently. And then from an administrative perspective, you may want to change the award types. We recommend that you shift from ISOs to non-quals or RSUs, so you don't have to deal with disqualifying dispositions and all of the tracking. Also, many companies discontinue early exercise. Again, some of the tracking and reporting issues can be much more challenging when you do become public.
Okay, so the next thing we'll move into is employee education. I think the important thing to start off with is it's dangerous for the companies themselves to be giving their employees tax advice. So what you want to do is bring in outside people to do the education of your employees so that there's no confusion as to who can answer those tax questions. That's not the company giving advice. They're going to want to understand, what do they have? What types of options do they have? What does it mean if they exercise early? Don't be confused by the fact it's an incentive stock plan. That does not indicate that it's an incentive stock option. So the type of grant they receive is really important. An RSU is a restricted stock unit that at the time of vesting is treated like a bonus would. And so when you bring in individuals to do education for your employees, you'll want to make sure that they cover the issues of AMT and how it affects the individuals, as well as the impact it has on the company from a tax perspective. How does the company treat it? How does the company handle withholding requirements and expensing for tax purposes? So you want to be able to because the options are a benefit to employees, you want to take care of them and give them as much education as you can.
Real quick before we hit on our next client spotlight, I wanted to point out we have a question regarding the shares reserve, and the question is, does canceled shares include forfeitures, I believe is the question, and the simple and quick answer is yes. Looking at FireEye. FireEye is the next generation in cyber threat protection. And I can attest to how seriously they take security, as it took me 30 minutes to get into their building last time I was over there. They take it more seriously than the TSA, thank goodness. Multinational, they're a multinational company that started planning for their IPO 18 months ahead of time. When they came to Armanino, they had no reconciliation of their equity plan history, no historical expense calc, or fair value recorded. So we worked with them, helped them clean up their books and their stock option plan data history, and helped them prepare for their IPO. We helped get their plan history reconciled and helped them calculate their expense. We helped prepare and communicate with their auditors and their SEC reviews, drafted their footnotes. And also they went through a merger right before one of their year-end closes, and so we helped them navigate that as well. Going forward, FireEye has partnered with the equity team here at Armanino, and we help them with their quarterly filings and their stock-based comp expense calc.
Great. With that, let's take our last polling question for today. The question is, what is the biggest challenge when educating employees? Is it A, just the basics of an award, B, tax concepts, C, appreciation of value, D, liquidity of opportunities, or E, not sure?
There's no right answer here, by the way, in case people were wondering.
Wow, way to let go of that trick question, Scott.
Oh, sorry, Sartaj.
A lot of people are coming in heavy on tax concepts.
Yes, not surprisingly.
I think value of the award is a tough one. I think people commonly misvalue the awards. All right, we're closed. 58% on tax concepts and 21% on just the basics of the award.
Yeah, not surprising. I don't think the tax is definitely a complex area in the equity arena. So we're gonna. Well, actually, this is your slide. I'm gonna steal it from you. So I'm not gonna steal it from you.
Yeah, hey, lay off. All right, so looking at the established stage, we're moving forward into established companies, which are companies that have been around for a while, hit their rhythm. They're now foreseeing and avoiding problems and applying modeling techniques, refining their market plan and operating procedures. So here we're going to discuss restructurings, which are stock splits, recapitalizations. We're going to look at the reporting demands that are now being imposed upon your company, the liquidity of the company's awards, and finally, we're going to take a look at communicating the value of your stock option plan to the employees.
So talking about restructurings, as John mentioned, that's stock splits, recapitalizations. You might have some down rounds. You might have new investors that come in to recapitalize the company. Repricings also. We see that often when a repricing, just so everyone's on the same page, is typically, right, if you've had a down round or the market price has dropped, even if you're a public company, the market price has dropped, and now the company's decided to reprice. So they've decided to change the exercise price to lower it down to whatever the market price is, so that employees are no longer owning options out of the money, I should say. In order to manage these challenges, again, if you're an established company, hopefully you have some infrastructure already, have a system, a good team in place is important. Again, the accounting expertise is going to be necessary for handling recaps and repricings and some of the more complex items here. And get your auditors involved ahead of time. Many times, companies only talk to their auditors at the end of the year when their audit's coming up. If you do have one of these events that you're planning for or that comes up, make sure you bring your audit team into the picture, into the conversation, And lastly, involve tax and legal folks. While you may not think there are any legal or tax consequences to whatever transaction you're working on, quite frankly, there might be some hidden pitfalls. On the reporting side, as you grow and you have just more history, the sheer quantity of data becomes more challenging. We've seen this in a number of cases, and we'll talk about it in our case study, but being able to report to the board, being able to look something up for an employee, or being able to look at a snapshot historically can become much more challenging the more history and the more data you have. The other thing is, don't analyze the costs and benefits of what you're doing today. Don't just continue to do what you're doing. You may have the opportunity to become more efficient. You may have the opportunity to tweak something or pass something off to a different department within the company. So just because you've done it that way all the time doesn't mean that today, as your company has evolved and changed, it may not be the best way. We actually do health checks for companies to go in and look at their processes, look at their system, make sure things are set up, and really provide some of these nuggets of value on areas where they may be able to improve their processes. Employee engagement becomes more important, and we'll talk about that in a moment. But as you, again, go further down the path, liquidity maybe has taken longer to achieve than expected. That becomes important. So as an individual, obviously, we recommend staying on top of equity issues and networking and learning trends on other companies in your like industry or like stage can be important. And automating. I think we've touched on that a lot, but automating just makes your life a lot easier and more efficient. So talking about liquidity, obviously a challenge might be finding it, getting it, but there's ways from an employee or from an equity plan perspective to offer liquidity to your employees or your participants or even your investors. Be creative and look at various options. We've seen a number of later or longer stage companies that have employee share buyback programs. You can also look at secondary offerings. So you want to consider not only the intangible cost of having new investors or taking money or equity off the table for your employees, which could also be viewed as cashing them out as their risk in that, but the tangible cost of actually implementing a share buyback program or a secondary offering can be very expensive just purely from an administrative cost of doing so. But really, I think figure out a process, what employees or founders might be looking for, and make sure to include your advisors. Do you want to chime in on that, Tom? Or?
Well, I think that one of the things we occasionally see will be a investor coming in, especially with earlier stage companies, an investor coming in and deciding that they want to try to purchase some shares of stock from existing employees, and you just have to be careful that how that pricing goes. Like Scott said, bring in your advisors, because any price offered can have an impact on your 409A valuation and the option pricing. But there is a way to do it. You have to be careful about who you're offering it to, and is it proportionate to everybody. So if you're looking at a buyback or a repurchase of shares, just make sure you plan it out with your attorneys and accountants.
So, and talking more about employee engagement, again, if you are a later stage company, you may have awards that start to expire. So what does that mean? And how do you communicate that? Tom and I were talking about the other day, getting a legal opinion on whether and how you should communicate expirations to employees or how not to, and what process you want to take. There can be some ramifications either way, depending on how you do it and if you don't do it consistently. The other thing is refresh grants, right? Most companies like to have all of their employees having some equity that's vesting. If you do have a broad-based plan, that is. So managing refresh grants, at what level, how many grants, modifications, right? If you are running up against some expiration dates, should you extend the expiration date? If you are granting ISOs and they already have a 10-year, ISOs being incentive stock options, and they already have a 10-year life, if you do extend that expiration date, you're going to trigger non-qualified option and tax consequences. So that's something to be aware of. And do your employees still understand or still value your equity? And I think that really goes back to what Tom was talking about on education, right? Did they understand it in the first place might be a question, but now maybe things haven't gone as well or as much as planned, or you just decided to wait longer to liquidate because you haven't found the right opportunity or hit the milestone you wanted before going public. Do companies understand that? Have you communicated that internally, sort of what the plans are? So I think it's important. Education sessions. We talked about the online portal, so employees have access to their data. And then really baking your employees into the process, the communication, etc. So our last case study, Landcope is also a security company working with enterprises across the industries, across the world. A great company based out of Atlanta, or Georgia, I should say. They're not out of Atlanta, Alpharetta. But they also offered a broad-based equity plan. They had about 11, 12 years of history. They had multiple folks inside their organization that managed different components of the equity plan. They were doing stock-based comp in Excel. And really, it was a manual, timely, and long process to prepare for audit, cap tables, and the like. And again, they've been doing it this way for a long time, but they had somebody that recognized, hey, there's a better way to do this. They implemented a cloud-based system. We helped them convert all of their data, review it, make sure the history was accurate, and got into the system properly. And ultimately, they decided that this wasn't a value add to their organization, and it wasn't something that they needed to necessarily manage internally. And they decided to outsource the management of the equity plan and the cap table and really keep that as one solution, one piece connected. So instead of the cap table being somewhere and the expense being somewhere else, it's all housed under one place, under one service provider. And they have access to the system so they can also run reports and get data when they need it. So they're a great client of ours. We're happy to have them. And they really did it the right way in saying, hey, our processes, just because we've done it this way for so long, isn't the way we have to do it. Looks like this slide didn't get updated. Our apologies.
Got it. Okay.
So yeah, I mean, basically today we've covered the management of equity throughout the various stages. I think some of the key concepts we talked about was presenting to your board. Sorry, the team is laughing over here. Somebody missed the bucket. We apologize for that.
By somebody, we mean no.
Fair enough. Pointing fingers. Anyways, hopefully you've gained some knowledge on, presenting to the board, presenting to investors. Employee education is a key component to having a successful equity plan. Having people understand what they're getting and understanding the value of it. That's really what we want to convey. And it looks like we do have maybe one question we haven't answered, and Tom's going to go ahead and answer that for us.
Yeah, we have a question here about the ISO and the $100,000 annual limit. The question had to do with, is it for all ISOs granted to an employee, and what if an employee has 5 grants and the vesting of all together is over 100,000? Would it make the grant over 100,000 ISO, or do all grants become NSOs? The issue here is that you have to look at the grants in sequence. So if you have a grant of 100,000 shares, let's say, that are going to vest 25,000 each year, and those amount to, say, $100,000 a year in value based on the option price, then that means that all future grants during those same calendar years as they vest, the additional grants will be triggered as non-quals. If you have a grant of an option that exceeds $100,000 per year, it's the excess that is a non-qualified stock option, does not recharacterize all of the options from ISOs to non-quals. One other further note just to keep in mind is that you can have a recharacterization of an ISO down the road. And so we could talk about that in education if you decide to go down that path of educating employees.
Yeah, what Tom's talking about there is a disqualifying disposition. Basically, right, if you don't hold the ISO long enough after exercise, which would be a year or 2 years from grant, and you sell those shares that you received from your ISO exercise, then it becomes a disqualifying disposition. There's company reporting requirements and taxable consequences for the employee. So,
Great. With that, we're going to wrap up the webinar. Please find our presenters' contact information on the screen should you have any further questions. As a reminder, all participants will receive instructions to access a certificate of completion if they meet the CPE requirements. As you exit our webinar, please take a minute to fill out our brief evaluation. Your feedback is very important to us. Thanks, everybody. Have a good day.
thank you very much.
Thanks.